Hi, everyone, and welcome to the Property Wealth Podcast. Today, we're diving into a topic that can really help you save some money on your tax bill.
Absolutely, Sarah. We're talking about depreciation and how it plays a crucial role in real estate investing.
Right. It's one of those things that can sound a bit complicated at first, but once you break it down, it's really powerful.
Exactly. Many investors aren't fully aware of how depreciation works and how it can significantly reduce taxable income, which, means more money in your pocket.
And we'll also touch on some practical strategies, like how to maximize your depreciation benefits and the common pitfalls to avoid.
Plus, we'll share some real-life examples so you can see how it all applies to actual investments.
Yes! It's all about making this information relatable and actionable for our listeners, especially if you're looking to build long-term wealth over 40.
And we'll also discuss the importance of consulting with a tax professional because every situation is unique, right?
Definitely! So let's get into it. Mike, could you start by explaining what depreciation actually is?
So Sarah, when it comes to depreciation, I think it's really important for folks over 40 to understand why this matters now more than ever, right?
Absolutely, Mike. A lot of people in that age group are starting to think more seriously about retirement and how they can make their money work for them.
Exactly. And with inflation being a concern lately, we've seen prices go up on everything from groceries to gas. Real estate can be a solid hedge against that.
Right. So how does depreciation fit into that picture?
Well, depreciation is a way to reduce your taxable income. Essentially, your property is losing value on paper, which gives you a tax break. For someone nearing retirement, that can mean a lot more money in their pocket.
That makes sense. So if you have rental properties, you could potentially lower your tax bill significantly, freeing up cash for retirement expenses.
Exactly. I've talked to many investors who were surprised at how much they could save. One guy, the first let's call him Tom, he's in his late 50s. He bought a couple of rental properties a few years back, and when he learned about depreciation, his tax bill went from thousands to just a few hundred.
Wow, that's a huge difference.
Right? And Tom used that extra cash to pay down his mortgage faster and contribute more to his retirement fund. It's all about leveraging what you have to ensure a more comfortable retirement.
So it's not just about saving money now, it's about setting yourself up for the future.
Exactly. And let's not forget about the current economic trends. With interest rates fluctuating and the market shifting, real estate remains one of the most stable investments. People over 40 can feel more secure knowing they have tangible assets that can appreciate over time.
Yes, and it can be a great way to transfer wealth to family as well. Imagine passing down a property that has appreciated and has been tax advantaged through depreciation.
Right, and that can create a legacy. I remember hearing about a couple, the Johnsons, who bought a rental property when they were in their 40s. Fast forward to today, their kids are in their late 20s, and they're planning to inherit that property. The equity built up over the years is going to give those kids a solid head start.
That's such a great story. It's like a gift that keeps on giving.
Yeah, and it's not just about the financial aspect. It's also emotional security. Knowing you've built something that can support your family, that carries a lot of weight.
Definitely. It can alleviate that worry about the future, especially as we see the cost of living increasing.
Exactly, and for many, real estate feels more stable than other investments like stocks. It's a tangible asset, something you can see and touch.
And that gives people a sense of control, right?
Yes! People want to feel like they have a handle on their financial future. And with depreciation, it's like a smart strategy that not only helps with taxes, but also adds to that feeling of control.
So, what are some of the strategies people can explore to take advantage of depreciation?
Well, first, it's all about understanding how depreciation works, knowing the different methods, like straight line versus accelerated depreciation.
Right, and a lot of folks might not even know that they can take depreciation on improvements they make to the property, not just the building itself.
Exactly. If you add a new roof or renovate a kitchen, that can all be depreciated. I've seen investors really maximize their tax benefits by doing this.
Makes sense. So keeping track of expenses is key too.
Absolutely. Another strategy is to consider short-term rentals. They have different depreciation rules, and in some cases, you can write off losses against other income.
That's interesting. So it could be a win-win for those looking to boost their income while also taking advantage of depreciation.
Yes, and there are also opportunities for cost segregation studies where you break down your property into different components to accelerate depreciation on certain items.
Wow, that sounds a bit complex, but potentially very rewarding.
It can be, but working with a good accountant or tax advisor can really help navigate that process.
And for those who may feel overwhelmed, starting with a single rental property might be the way to go.
Exactly, it's about taking those baby steps. And once you see the benefits of depreciation on that first property, it can really motivate you to expand your portfolio.
And the earlier someone starts, the more they can benefit from it over time, especially as they approach retirement.
Right, it's all about planning for the long haul, and depreciation is a powerful tool that can make a significant difference.
So for someone listening who might feel hesitant, what would you say to encourage them?
I'd say, don't let fear hold you back. Real estate has been a proven path to wealth for many, and with the right strategies, including understanding depreciation, you can build a solid foundation for your future.
That's a great perspective, Mike. It really is about taking control and building something meaningful.
Exactly. And for those ready to dive in, let's talk about some concrete strategies next. So let's dive into depreciation. It's one of those terms that sounds complicated, but really, it can be a game changer for your tax situation.
Right? It's fascinating how something like depreciation can actually help you save money. Can you break it down a bit for us?
Sure. Basically, depreciation allows you to deduct a portion of the property's value over time, which reduces your taxable income. For residential properties, the IRS allows you to depreciate the value over 27.5 years.
Okay, so if you buy a rental property for, say, $275,000, you could deduct about $10,000 each year, right?
Exactly. You take that $275,000, subtract the land value because you can't depreciate land, and then divide the remaining amount by 27.5. So if the land is valued at $75,000, you'd be looking at $200,000 to depreciate. That gives you around $7, $273 a year.
Wow, that really adds up over time. So that's a straightforward way to lower your tax bill. What about other strategies?
Well, another important rule to consider is the 1% rule.
Oh, I've heard of that one. It's where you want your monthly rent to be at least 1% of the purchase price, right?
Yes. So if you bought that same property for $275,000, you'd want to rent it out for at least $2, $750 a month. It's a quick way to gauge if a property is worth your time.
So if it doesn't meet that 1% rule, it might be a red flag?
Exactly. It's not a hard and fast rule, but it gives you a good baseline. And then you can layer on other metrics, like the 50% rule, which states that you should expect to spend about 50% of your rental income on expenses.
Right, so if you're bringing in $2, $750 a month, you'd want to budget around $1, $375 for expenses.
Spot on! And that leaves you with a clearer picture of your cash flow.
I love how these rules of thumb simplify the process. Are there any other metrics we should keep in mind?
Sure. The cap rate is another good one. It's really useful for assessing the potential return on an investment property.
How do you calculate that?
You take the net operating income, or NOI, which is your rental income minus operating expenses, and divide that by the property's purchase price.
So if your property generates $30,000 a year in NOI and you bought it for $300,000, your cap rate would be
10%. You'd calculate it like this: $30,000 divided by $300,000. A higher cap rate generally means a better return, although it can also indicate higher risk.
Got it. And I suppose different markets have different cap rate expectations, right?
Absolutely. In a hot market, like San Francisco, you might see lower cap rates because property prices are so high. But in a less competitive market, you might find much higher cap rates.
So it's all about finding the right balance for your investment goals.
Exactly. And speaking of goals, it's essential to have a deal evaluation checklist when you're considering a property.
What kind of things should be on that checklist?
We'll start with the property's location. Research the local market trends, like job growth in school districts.
those factors can really affect property values, right?
Definitely. Then check the property's condition. Look for any repairs needed, which could impact your cash flow.
And what about financing options?
Ah, yes. Understanding your financing options is crucial. Many investors use conventional loans, but there are also FHA loans for lower down payments or even creative financing options like seller financing.
I love the idea of seller financing. It opens up a lot of possibilities.
It does. With seller financing, the seller acts as the bank, and you agree on a purchase price, interest rate, and payment schedule. It can be a win-win if the seller is motivated.
And you can negotiate terms that work for both parties.
Exactly. Just keep in mind, you'll want to do your due diligence and ensure the numbers work for you.
That makes sense. So let's say you find a property that meets all these criteria. What's next?
Well, before you jump in, you should consider your exit strategy. Are you looking to hold long-term or flip the property?
That can really shape how you evaluate the deal, right?
Absolutely. If you're flipping, you need to factor in renovation costs and the time it'll take to sell. If you're holding, consider the long-term cash flow and appreciation potential.
So many moving parts.
It can feel overwhelming, but that's why having a solid plan and sticking to your checklist is key.
And that brings us to common pitfalls. What are some of the biggest mistakes you see investors make?
Well, one major pitfall is underestimating expenses. Many new investors forget about things like property management fees, maintenance, and even vacancy rates.
Right, those costs can really eat into profits if you're not prepared.
Exactly. And another common mistake is not doing enough market research. You really need to know the area you're investing in. What's the rental demand like?
And I imagine making emotional decisions can also be a trap, huh?
For sure. It's easy to fall in love with a property and overlook the numbers.
So keeping emotions in check is crucial.
Absolutely. Well, it's all about being informed and sticking to your strategy.
This has been super insightful. I can't wait to hear more about those pitfalls next.
So Sarah, let's dive into some of those common pitfalls that real estate investors often stumble into. It's surprising how sometimes, the simplest mistakes can really derail your plans.
Absolutely, Mike. I think one of the biggest traps people fall into is over-leveraging. They get so excited about a property that they stretch their finances too far, thinking they'll just flip it or rent it out quickly.
Yeah, that's a classic mistake. I remember a client of mine, let's call him Tom. He bought a property thinking he could renovate it and sell it for a profit, but he took on way more debt than he could handle, assuming the market would stay hot.
What happened to Tom?
Well, the market shifted. He ended up with this property that, instead of appreciating, started to lose value. And with high monthly mortgage payments, he was drowning in debt. It took him years to recover, and he learned the hard way that, having a solid financial cushion is crucial.
Right, and it's so easy to get caught up in the excitement of a new project. What about tenants? I know bad tenants can really cause headaches.
Oh, for sure. I've seen that too many times. One of my past clients, let's call her Lisa, she had a rental property but didn't do her due diligence on the tenants. She was just eager to fill the vacancy.
Yeah, who wouldn't be, right?
Exactly. But she didn't check references thoroughly. The tenants moved in, and it turned out they were, a bit of a nightmare. They were late on rent, damaged the property, and she ended up spending more on repairs than she made in rent.
That's frustrating. It seems like taking the time to screen tenants properly could save a lot of hassle down the line.
Definitely. It's a little bit of work up front, but it pays off in the long run. And speaking of cash flow, ignoring it is another big pitfall.
Yes! I've heard people say, the property will appreciate, so I'll be fine. But that's risky, isn't it?
It really is. I had a colleague who bought a property, and he was so focused on the potential appreciation that he didn't pay attention to the cash flow. He ended up with very little left after expenses, and when unexpected repairs came up, he was in trouble.
What kind of repairs did he face?
Oh, things like a leaky roof and a broken furnace, those surprise costs that pop up, they really add up. If he'd been more focused on cash flow, he could have made better decisions about how much to invest initially.
That's such a good point. And timing the market, that's another trap, isn't it?
Absolutely. I think People often believe they can time their entry into real estate perfectly. I had a friend who waited for the perfect moment to buy, thinking prices would drop.
And did they?
No, they didn't. They actually shot up, and he missed out on a great opportunity. It's like trying to catch falling leaves. Very tricky.
So what's the takeaway from that?
The takeaway is to focus on a long-term strategy, rather than trying to predict the market. Buy when you find a property that fits your goals, rather than waiting for the stars to align.
Makes sense. And what about hidden costs? Those can really sneak up on you, can't they?
Oh, absolutely. I had a client named John who bought a property without considering the hidden costs, like property management fees, maintenance, and even the cost of insurance.
Did he end up regretting it?
Very much so. He found that his annual expenses were significantly higher than he anticipated. It cut into his profits, and he quickly realized he should have planned better for those ongoing costs.
It's really all about doing your homework, isn't it?
Exactly. A thorough analysis before you buy can help you spot red flags early. Look for things like high maintenance costs in a property's history or neighborhoods with declining rental demand.
Those are great tips. So if someone finds themselves in one of these situations, what can they do to recover or avoid these pitfalls in the future?
Well, first and foremost, it's important to take a step back and assess the situation. If you've over-leveraged, you might want to look into refinancing options or even selling if it makes sense financially.
And what about tenants?
If you've got bad tenants, it's crucial to know your rights as a landlord. Sometimes, it might be worth it to start the eviction process sooner rather than later, especially if they're causing damage or not paying rent.
And for cash flow issues?
If cash flow is tight, consider ways to reduce expenses. Maybe renegotiate some service contracts or raise the rent within legal limits. Be proactive about it.
That's solid advice.
And for hidden costs, always budget a little extra for unexpected expenses. It's better to overestimate your costs than to be caught off guard.
Great reminders, Mike. It really comes down to being informed and prepared, doesn't it?
Exactly. Knowledge is power in real estate investing. The more you know, the better decisions you can make.
That's a great note to end on as we transition to our next steps.
Right. So let's talk about how to build that strong foundation for success in real estate investing moving forward. All right. So let's dive into some immediate steps that folks can take right now to really leverage depreciation for their tax benefits.
Yeah, I think that's super important. What's the first thing they should do?
Well, the first step is to review your current investment properties, if you have any. If you haven't done a depreciation analysis yet, that should be your priority.
Right, and how can they do that?
A great tool for this is the Bigger Pockets calculator. It's really user-friendly and allows you to input your property details, and it'll help you see how depreciation impacts your returns.
That sounds helpful.
Yeah, and if you're just starting out, I'd recommend checking out local listings on Zillow or your local MLS. Get a feel for property values and what's available in your market.
So it's about understanding the market as well, right?
Exactly. And once you find a property you're interested in, start analyzing it. Maybe set a goal to evaluate one deal per week, just to practice.
That's a manageable goal for people, especially if they're busy.
For sure. And if you're looking for a more in-depth understanding, I'd suggest checking out some books on real estate investing, like the book on rental property investing by Brandon Turner. It's a great resource.
I've heard good things about that one. Are there any podcasts you'd recommend too?
Absolutely. The Bigger Pockets podcast is a fantastic one. They cover a ton of topics, including depreciation, and they have interviews with experienced investors who share their insights.
Sounds like a gold mine of information.
It really is. And, building your network is just as important. Look for local real estate meetups or networking events. That can be a great way to learn and meet like-minded people.
Yeah, connecting with others can really inspire you and keep you motivated.
Right, and don't forget to think about hiring a professional, like a tax advisor or a real estate accountant. They can help you navigate depreciation and make sure you're maximizing your deductions.
That's a great point. Sometimes it's worth investing in expertise to save more in the long run.
Exactly. And if you're a DIY type, there are apps like Rentometer that can help you analyze rental prices in your area, so you can gauge your potential income versus expenses.
That's so useful. It's all about making informed decisions, isn't it?
Absolutely. And remember, start where you are. even if it feels overwhelming. You don't have to know everything at once. Just take small, actionable steps.
That's really encouraging, and consistency is key, right?
Yes! Even just dedicating a little time each week to learn or analyze properties can make a big difference over time.
And what do you think about setting reminders or goals?
Great idea. You might set a reminder to check your property's value or to review your expense reports monthly.
That's a nice way to stay on track and keep your focus.
Yeah, and then there's always the option of looking into depreciation software. There are several out there that can help automate the calculations for you.
That sounds like it could save a lot of time.
Definitely. And if you're ever unsure about something, don't hesitate to reach out to a community, like an online forum or a local real estate group.
There's power in community, for sure.
For sure. So those are some practical first steps. Now let's bring this all together. All right, so as we wrap up, let's just recap a few key takeaways about depreciation and how it can really, lower your tax bill.
Yeah, absolutely. First off, depreciation is this powerful tool that allows you to deduct a portion of the property's value, right? It's like having a built-in tax break that can really make a difference.
Exactly. And remember, it's especially beneficial for long-term investors. It helps you keep more of your profits, which is crucial when you're looking to build wealth over time.
Right, and don't forget about the importance of understanding the different methods of depreciation, whether it's straight line or accelerated. Knowing which one to use can seriously impact your bottom line.
And let's not overlook how depreciation can even affect your cash flow. It's not just about saving on taxes. It can improve your overall investment strategy.
Yeah, and for anyone looking to invest in real estate, taking advantage of depreciation can really enhance your portfolio's performance. It's all about working smarter, not harder.
Absolutely. So as you think about your real estate journey, remember that building wealth through property isn't just about the initial purchase. It's also about maximizing every tax advantage available to you.
Well said. And if you found today's discussion helpful, please take a moment to like and subscribe to our channel. We'd love to hear from you too. Leave a comment sharing your biggest takeaway or any questions you might have.
And if you know someone over 40 who's thinking about venturing into property investment, share this episode with them.
Next time, we'll be diving into bonus depreciation and cost segregation. It's going to be a game changer for many of you.
Yeah, we can't wait to explore that topic. Until then, keep investing wisely.
Thanks for joining us today. Take care, everyone.